Hey everybody, Dave here, Hidden Freedom Investing. In today's video, I want to talk about some dividend terms, acronyms, and some other important information for dividend investors, especially if you're just starting out. Maybe you don't know some of this information. About a month ago, I did a how to start a dividend portfolio, basically from scratch. There were some questions and some comments. So this video is to address some of those questions in there and kind of dig a little bit deeper in some of those concepts / acronyms and some other things I talked about in that video. If you have not seen that video, go ahead and take a look at that video up here and you'll see what I'm talking about. So let's not waste any time, let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. So the first thing we're going to talk about here is we're going to talk about DRIP, okay, and that stands for Dividend Reinvestment Program. Some brokers call it something else. They all have a limitation. They might call it something else, but in general, it's called DRIP, Dividend Reinvestment Program. Scottrade and TD Ameritrade, for example, called it something else, and it actually was a pretty cool implementation that they had. Well, actually, TD Ameritrade is still around, so they do have that implementation of it, and I can kind of touch on the nuances of their implementation, but in general, every single platform should have something very similar to something called a DRIP, and that's Dividend Reinvestment Program. So that means that if you receive, say, $40.51 from Caterpillar in dividends, what that's going to end up doing is they're going to end up putting that money back into that same stock that it came from, most likely, and $40.51 will go back right into that stock. Unless you're in, say, TD Ameritrade or, Scottrade, which is gone, got sucked in by TD Ameritrade. When you kind of have control where to put that money, it kind of goes into a different bucket, and then from there, you can set a percentage and tell it what stock to go in, whatever is signed up for the program. But in general, most brokers will put it right back into the same stock. And Schwab, for example, which I'm using, puts it right back into the same stock. So if it came from Caterpillar, it's going to go right back into Caterpillar. So here we are looking at my Schwab account, and this is kind of just a history of some transactions for just a few days. And I received a dividend here on March 16th for Duke, an amount of $100.10. And then you can see the next day that the platform automatically invested back into Duke that $110. It bought 1.075 shares, and the cost of the shares was $93.11, almost 11. It was 11 cents and 42, whatever, if you want to round that down, I guess. And then we received another one here on Home Depot for $20.34. Very next day, it invested back into Home Depot. It bought 0.677 shares, and the price at the time was $300.58. And we got another dividend here. Here's some ETFs here that got invested. We received the dividends here, $590.92 on VYM. That got invested the very next day. $590.92. It bought 5.8674 shares. The price at the time was $100.71. And then obviously we received a dividend there on Newsea the same day we got one. Actually, it wasn't the same day. The very next day we received one on Newsea for $642.81. That got invested a few days later. That was probably on over a weekend, so it got invested probably on Monday. And then bought 24 shares in 24.1436 shares. And the cost at the time was $26.62. So that's what we're talking about right here. We're going to talk about what fractional DRIP is next. And since we're already in here, so fractional DRIP is basically what you see exactly right here. If we received $100.10 here on Duke, what fractional DRIP means that it's going to buy more than just one share. It's going to use up the complete $110.10 exactly. So that's exactly what it did here. The very next day, invested back into Duke that $100.10. Since the share price was less than $100, it bought more than one share. Okay, so that in the case here is one share, 1.075 shares it bought to bring it up to the $100.10. So that is what fractional DRIP is. Not every broker offers fractional DRIP. You really want to make sure if you're building a dividend portfolio that you are in a broker that supports fractional DRIP. That's important, right? So what if it was you had a broker that did not support fractional DRIP? Well, that means it would have only bought $93.11 worth of Duke, and the rest of the money would have stayed in your account as cash. This is the reason why I got out of Interactive Brokers, because at the time they did not support fractional DRIP. They have a DRIP option, but they did not support fractional DRIP. And if you're building a dividend portfolio, in my opinion, that's a pretty big thing you need to have, a fractional DRIP, to make sure that money goes right back into that stock, the full amount. If it was off just by a little bit, it would just put the cash in your account, and that's money that's not getting reinvested automatically. And if you're in a coma, because I've talked about coma money, right? If you're in a coma for 10 years, what about having all those fractions that are just going in your account that are not getting reinvested, right? That could hurt you big time over a long period of time. So we've talked about DRIP and we've talked about fractional DRIP. Let's go ahead and just real quick mention what fractional purchase is. Okay, so fractional purchase means that if a stock is $100 per share, but you only have $50, you can buy $50 worth of that and you get 0.5 shares of that stock. Okay, not every broker offers fractional purchase, fractional share purchase. Some have different implementations of it, like Schwab, for example, only does fractional purchase on S&P 500 stocks. A lot of other brokers out there offer just fractional purchase. I think Robinhood does, M1 does, I think Fidelity does as well. So that is a good feature that I highly recommend if you're building a dividend portfolio, especially if you have a lower amount in your dividend portfolio, you're just starting out, then fractional purchase could help you out getting some of those better, higher price stocks. I wouldn't call them better. Just because higher price does not mean it's a better stock. It just means that they have a lower float. So it doesn't mean the stock is cheap or anything like that either. So if Ford's, $5 per share and GM is $30 a share, that does not necessarily mean that GM is a better stock. Okay, so that's a whole different ball game there. I'm not going to talk about it in this video. Just know that if you have a $300 stock, that does not mean that it's better than a $100 stock. It just means that they don't have as many shares out there outstanding, or that could be that possibly the stock has run up, so it's a little bit overvalued. But just because there's a high stock price does not mean that the stock is overvalued either. Okay, you need to look at some other information for that. Like I said, we're not going to touch that in this video. Let's just say you had about $200 to invest right now, but you wanted to buy some Home Depot. I think Home Depot is around $300 a share or so. And instead of waiting until you have $300 to invest into Home Depot, what you could do is you could buy $200 worth of Home Depot at 0.7 shares or something like that. Not every broker offers that. So that is a good reason to have fractional purchase. And I talked about it in the last video, or how to build a dividend portfolio. And some people are kind of asking questions about that, but that is what that means. Fractional purchase is an important thing to make sure a broker supports that. So at the end of the video, I will talk about a broker that I recommend for brand new investors. So if you are getting started, go ahead and wait till the end of the video to watch that portion. For future videos, go ahead and like and subscribe and hit that bell notification. So the next thing we're going to talk about right now is dividend dates. Okay, so those are pretty important dates there. There's quite a few of them. There's like 4 different ones. There's really only one that really matters, maybe 2, I suppose. But let's go ahead and talk about those dates. So here are the 4 dates right now. We're on Seeking Alpha up here, and I just have Caterpillar brought up just because they did raise, no, excuse me, they didn't raise. They just declared a dividend recently, even though it's not showing on here, but we will bring that up here in a second. So here are the 4 dates right here. Okay, the very first thing you get is normally the declare date. Okay, so this one's, in this case here, this was December 9th, 2020. You have a record date of January 20, 2021. You have a pay date of February 19, 2021, and you have an ex-dividend date, which you might have even heard of. If you haven't, then you're going to get familiar with what that is. January 19, 2021. So the very first thing that you normally hear about is a declare date or announce date. That could be called announce date as well. And what that is just means that that's the day that the company puts out the information when they're going to pay their next dividend. And normally in that declare date, they normally put these other 3 dates in there. So you have a record date, pay date, and ex-dividend date. So what is record date, what is pay date, and what's ex-dividend date? So at this point, the next date that matters here is ex-dividend date. Okay, and what that stands for is if you buy the stock on the ex-dividend date or after, you will not get the dividend. okay, until the very next quarter, or if it was a monthly payer, you wouldn't get it till the very next month. So you can see here they gave you a little about over a month. You know, they declared the dividend here in what was that, December 9th, and there actually goes ex-dividend here in January 19th. So it gives you a little bit more than, 40 days there to buy the stock, and you're still going to get the dividend for that next pay period, okay? So in that case here, you need to buy the stock as much as you want or as much as you can prior to the ex-dividend date. If you buy it on the ex-dividend date or after, you will not get the dividend for that pay period or that payout date, which is right here. And that means if you kept the shares in there until the very next payout, which would not most likely would be 3 months later, you will get the dividend then. And the reason why they have the ex-dividend date is because it takes about 2 days for the stock shares to settle, and that's what the record date comes in handy here. In this case here, they actually have the record date as the very next day, which is fine. And it's normally never the same day. It's sometimes 2 days after the ex-dividend date. But the record date always falls after the ex-dividend date, and then obviously you're already locked in at this point. As long as you bought before ex-dividend date, you will get the dividend, which pays out on February 19th. So those are the 4 dates right there that matter, and honestly, really the only one that really matters is the ex-dividend date. Some people really care about the payout date as well. Because obviously, you know, that's going to show up in their account and keep you motivated, right? So you keep investing, and so obviously you're going to have fractional drip turned on, right? The declare date and the record date really don't matter, honestly. Declare date is something kind of cool to look at just to see, you know, when they actually declare it, if they raise the dividend, okay? Because they raise the dividend, you know, honestly, if you're in Dividend Aristocrats or Kings, they should have raised at least once a year. Sometimes they can get away with going a whole year without raising and still be counted as a Dividend King or Aristocrat. It just depends on when they raise it, which, you know, if it was the beginning of the year or something like that. But if it was in the middle of the year, sometimes you can get away with going 2 years. But I talked about that a little bit in the last video. So those are the 4 dates right there that matter. This one obviously pays quarterly here. And they just actually announced, so let's go ahead and look at that here. So here's the Caterpillar declares a 103 dividend. They did not raise this. So this is April 14th, just not even that long ago. I think it was today, actually, matter of fact, that I'm recording this. So they declare a dividend of 103 a share, quarterly dividend in line with previous, which just means they did not raise. That means their last dividend was 103 as well. And here's the date right here that we care about, right? So here's the declare date, April 14th. We have the pay date, May 20th. For shareholders of record of April 26th, ex-dividend date is April 23rd. So you have to buy it before April 23rd to get the dividend that gets paid on May 20th. This came from Seeking Alpha, by the way, so let's go ahead and take a look at Seeking Alpha, and I'll show you how to get these declares in your email if you want. So we're looking at Seeking Alpha right here, and you can create an account and set up kind of like a portfolio in here. Let's go to my portfolio, and you can actually do edit and all that stuff. And I got all my tickers in there, and what you can do is you can go over to, you know, add symbols and add all your tickers, and then you go to edit portfolio, and then you go to notifications, and you can have it email you the declares and all that stuff, and the dividend raises to your email, which is kind of cool because it kind of keeps you up to date when a company raises or declares. That way you can get, you know, extra money invested in that stock if you want. But because obviously, you know, Seeking Alpha and Schwab and all that, they kind of lag. They don't get that information and update their website. I mean, here it's already been, you know, a few days on another stock I looked at, like Realty Income, which just declared as well just a week ago or something like that. And it's not even showing on any of the websites that they declared. And obviously we just looked here at Caterpillar and they didn't even show that they declared. Obviously it was today, but maybe that'll update tonight. I don't know. Maybe I jumped the gun on that one. So that one should update maybe tonight. I don't know how often they do data update, but so if you want to set that up, just go to Seeking Alpha. It's free. You can just create an account and go to my portfolio, add your tickers in there, and then set the notification to your email. And it's kind of cool because you can get the declares and make sure you're invested. And you can also find out when they actually raise, because if they raise, it'll put in there, instead of saying inline, it'll say raised by, you know, 6% or something like that. And then they'll give the percentage. So the next thing we're going to talk about is we're going to talk about compounding annual growth rate. In this case, specifically dividend compounded annual growth rate. The compounded annual growth rate can be applied to a bunch of different things, but you might have heard of a CAGR in the past, or maybe not, but we're going to make you a little bit more familiar with that by looking at my dividend portfolio and also using kind of a theoretical example as well. So looking at my dividend portfolio here, we can see that we have an account weighted dividend yield of 4.39%. We have an average weighted 5-year dividend CAGR of 5.57%. That's for my dividend portfolio at this time. That's accumulation and weighted off of every single position I have right now. I have 27 positions in there, some which don't even have a compounded annual growth rate at all. And that's some of the ETFs. So let's go to my dividend portfolio here. Here is all of the positions of the dividend portfolio. Here's some ETFs down here. If we scroll over to the right over here, I have all the compounded annual growth rates. I got the 1 year, the 3 year, the 5 year, and the 10 year there for every one of the stocks. Obviously here we got JEPI in there. It doesn't have a compounded growth rate yet. I think they might, but they don't have one yet because it hasn't been a full year. And then we got NUS in there, which I don't even think is going to have a compounded annual growth rate. Let's see, we got VYM, that's Vanguard's high yield dividend. I don't know if it's high yield, but anyways, at 7.13%, actually was gone down since I think last year was 9% for the 5 year. But then we have Amplify, which is Devo, I think is at 9%. But so that's kind of weighted across every one of the stocks right there, 5.57%. So I took the weighting for every one of the stocks and it came up with a weighted average. So that's kind of important there. But we're going to also look at a tool that I put in the spreadsheet there so you can calculate it. I'm going to show you how to calculate it as well. But let's also talk about, why that is even important. All right, we're going to use a theoretical portfolio example, so I don't have to use all these funky numbers in my dividend portfolio. But so getting back to the theoretical $1 million portfolio, let's just say you had a 5% yield on it. That's going to generate you $50,000 of income every single year. Let's also say that you also have an average weighted 5-year dividend CAGR of 10%. So what's going to happen is your dividend, your $50,000 should grow by 10% every single year. So in that case here, your $50,000 times 10% should give you $5,000. So what's going to happen is you're going to get a raise every single year of $5,000. Obviously, if you're dripping those dividends at $50,000 back into the portfolio, that raise of 10%, the average weighted 5-year dividend CAGR, will go up as well. So it's going to compound not only that $50,000 plus the drip, right? So you're going to drip $50,000 into the portfolio, and that's going to drip in all the different positions. Plus, you're going to get that raise you're going to get a raise every single year, that 5-year dividend CAGR. At 10% as well. So obviously, if we go back to my dividend portfolio here, this is what this is talking about right here, the growth type. Okay, so dividend growth without dividends being reinvested. Okay, that's still going to grow every single year because we got a 5.57% average weighted dividend CAGR. So even if I'm not dripping those back into all the shares, I'm actually spending that money, my dividend growth should still go up every single year by 5.57%. Okay, obviously that could go up or could go down if stocks raise or lower their dividends, and that's fine. I mean, obviously last year a lot of companies lowered it, but and here's another example here. If you actually were dripping those, okay, let's just say you weren't using those dividends, you were actually dripping everything back into the shares that it came from. In that case here for 2022, I'd be dripping $21,000 back in. And that dividend CAGR, 5-year dividend CAGR, 5.57% would be compounded on that amount, okay? Plus the next year would be compounded, plus the next year would be compounded, plus the next year would be compounded, okay? So what that's showing you here is if I'm not dripping, my dividend portfolio still after about 12 years or so will still actually increase in value, will actually double in value. Okay, so we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So about 12 years or so, my dividends went from $21,000 to what, $39,000. If you actually want to really double it, it'd be about 13 years at 5.57%. So that's actually me using that money every single year, but my dividends still keep going up every year because of the 5-year dividend CAGR. Okay. And if we want to use the other example here, dividend growth with DRIP, let's say we didn't, weren't going to retire for 10 years or something like that. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 years later, we're actually making $59,000 in dividends every single year. That's the reason why DRIP and the 5-year dividend CAGR could make you quite a bit of money over, a substantial amount of time. Here I got, basically 25 years of dividend growth. And by the time 25 years, here's just a 25-year number right here. If I was actually using all the dividends every single year, not dripping at all, just because of the 5-year dividend CAGR up here being 5.57%, I would have $80,000 of dividends annually that would still be coming in off my dividend portfolio, even using the dividends. So another example here is if I was not using the dividends for 25 years, this is the reason why time matters. The quicker you can get invested, the quicker you can start building a dividend portfolio, the better. After 25 years here, I would have annual dividend of $662,000, almost $663,000 if I was dripping for 25 years at a 5.57% average weighted 5-year dividend CAGR. You add up all those dividends at the end of the 25 years, it'd be almost $4 million, over $4 million. If I was actually using those dividends after the 25 years, it would be $1.1 million in cumulative dividends. What stock in your dividend portfolio has the highest 5-year dividend CAGR? Comment below. Go ahead and like and subscribe and hit that bell notification. So how do you calculate the compounded annual growth rate for a stock? So here we are looking at Seeking Alpha again. If you actually go to the top up here and you go to dividend history, you go to dividends, dividend history, you can actually get the history for every one of the stocks or whatever ticker you want to pop up. In this case here, I'm actually using Caterpillar just because Caterpillar today seems to be the one I want to use. But let's just say you want to calculate what the 5-year dividend CAGR is on Caterpillar. So what we want to do is we want to go back 5 years. Here's 5 years right here. We want to add up all the quarterly dividends. So in this case here, it's 270s and 277s. So let's bring up a calculator here. I got a calculator here, so we're going to do 0.70 times 2, and then we're going to do plus 0.77 plus 0.77. So they have $2.94 they paid out in 2015. So what we're going to do is remember that $2.94, yeah. $2.94. We're going to go back to my dividend portfolio here. We're going to go to the tools in my spreadsheet because I put a tool section in here. We'll change this to 2015 because that's the starting year. That's not right. 2015. And then the starting amount was $2.94. And then the last thing we need to do is last full year of dividends was 2020. So let's go back to Caterpillar here and scroll up here. So go up 5 years, and the last full year they had was 2020, so that'll be 5 years. Here is the payout right there. It looks like they did not raise in 2020, so that's interesting. So that means actually lowered the dividend CAGR quite a bit. And so let's add up, let's see, 103 times 4. So the ending yield would be $4.12 for 2020. So we're going to pop that back into the dividend CAGR, so it's $4.12. So let's see, the tool, $4.12 for 12. And then we get the CAGR here is 6.98%. So if we go back to my dividend portfolio, let's see here, it's this Caterpillar. And we scroll up to Caterpillar, so here's Caterpillar right here. We did 5 years, remember? So 2015 to 2020, that's 5 years. So here it is right here, 6.98%. That's how you calculate the 5-year dividend CAGR. So let's do another example for the 3-year. Let's do the 3-year on, let's just do it on Caterpillar since we already have it up. So it's 9.95%. And we're just verified to make sure that is correct. This is how you can populate these numbers here. So what we're going to do is we're going to leave 2020 the same because obviously that's the ending year, but we're going to use the starting year as 2017. So in that case here we have what, 77 cents times 2 plus 78 cents times 2. So let's see here, 0.77 times 2 plus 0.78 plus 0.78. So that comes out to $3.10. Let's pop that back into the tool. And let's see, scroll over to the right over here, tool, $3.10. The ending year will be 2020, 20 still, and the starting will be 2017. And then the starting yield would be, it's not the yield, starting dividend amount, sorry, $3.10. And we get a dividend CAGR, that's a 3-year dividend CAGR at 9.95%. So if we go back to my dividend portfolio, that should be 9.95, which we already know it is because we just looked at it, so 9.95. So that is how you calculate, if you want to calculate the 1 year, the 1 year is very easy. It's just you go to the very last full year and then you calculate it off of that. That's whatever their percentage is. And then the 3-year dividend CAGR, obviously we went 2017 to 2020. The 5-year we went from 2015 to 2020. If we wanted to do a 10-year, you go back all the way to 2010 to 2020. So this tool is included in my spreadsheet. So if you do buy my spreadsheets, you get that tool included in there. Obviously, to calculate that out, there is the actual, what do you call that? I guess the formula, if you want to call it that. So there's the formula right there. If you're interested in creating that on your own, I'm not gonna, you don't have to buy the spreadsheet for that, but it is included in my spreadsheet if you want to. I do sell all these spreadsheets, and they're available if you want them. So including this page here. So the very last thing we're going to talk about here is M1 Finance. In my opinion, M1 Finance is one of the best platforms for beginner investors, or beginning dividend investors. Let's just kind of say that. There's other brokers out there that obviously offer more advanced stuff, a lot more research, and obviously they don't have trading windows and stuff. There's a lot of pros and cons with M1 Finance, but it also meets all the requirements here. Okay, so fractional purchase, fractional drip. Reinvest. You can also have it automatically take money out of your account every week. $100, $1,000, yeah, $1,000 or whatever, and then it will automatically invest that. Once it gets into the portfolio or into the account, it will automatically invest across the dividend portfolio. So it meets all the requirements that you want. You don't have to use my link, but I will include the link down in the description or the first pinned comment. If you use my code, you will get $30 of free money if you deposit $100. If it's an IRA, if you deposit $500, you'll get $30 as well, and then I'll get $30. So, like I said, it's not the the end-all, be-all platform, but it does meet all the requirements that I've talked about in this video. So I know this is a very long video. Let's go ahead and end the video here. If you have any comments, questions, concerns, go ahead and leave a comment below. Hit me up on Facegram, Twitter, or you can shoot me an email, or even leave a comment below if you want. Until next time, go ahead and like and subscribe. We'll see you in the next video. Thanks for watching.